Hi, and welcome to the Macro Show. We talk macro and try to make sense of markets that apparently people were waiting for today to go buy to new all-time highs. I'm your host, Steve Van Meter, and welcome to the show because I've got a whole bunch of topics I want to talk about. We've got gold mining stocks. I want to talk about gold miners. You're saying, wait. Are you no longer the bond king? My friends, need not worry. I want to talk about what gold mining stocks are signaling potentially, how that relates to inflation-protected securities or tips. I've got money supply stuff I need to talk about. Now, the other day I posted on Twitter, other day being last week, a thinking emoji. I was pondering the M2 money supply data, and people said, "Well, man, Steve must be pretty desperate when he's thinking about the money supply." You gotta love social media, right? No, I was really thinking about, why is money supply kind of flattish? And then my buddy Johnny Bravo, many of you are fans of his show, as I am as well. And he asked me, hey, why is the M1 rising and the M2's not? And I just needed to think about it. Sometimes when I have these bigger concepts that I don't have answers to right away, it takes a few days and I'm like, oh, okay. So I want to talk about that. I've got commitment to traders charts from Brent Johnson and Stefan to look at. We're going to look at the Treasury securities. We've got dollar. I've got stuff on the quants, the Treasury trading quants. Very interesting, right? Because we're the bond king here. So that's close to home. Got to look at that. What else I've got? I've got net interest margin. I've got economic data. We just need to get on with the show. Let's get into the data first because, I like to go through this. And we'll get into all this other stuff and charts, and we're going to have a good time today. Let's go back to Sunday because, again, there wasn't a normal Monday show due to the Martin Luther King Jr. Day holiday. And one thing I want to look at, particularly with China, is retail sales. Now, their industrial production was up year over year at 7.3%, and that's fine. But look, retail sales, in China, this number normally needs to be pretty strong. And you might say, well, wow, 4.6%. It's like, not as quite as good as you think. If we go back and look at a chart on the year over year basis, and you can see that retail sales in China are, pretty low at 4.6. And if we zoom in, what do you start to see? It's rolling over. And that is actually a pretty big concern of why is this thing rolling over? And it's not just the U.S. economy that's slowing down, it's the global economy. Oh, I forgot to pull up charts for the money multiplier. We'll try to do that. So if you don't know, the show is recorded live and unedited. I don't believe in editing, so we'll see if we can make this work. Capacity utilization in Japan, it's only month over month. Don't care about that. How about into Monday's data? CPI from Italy holding steady at minus 0.2%, so still deflationary. And, I need to mention here, because so many people think that interest rates in the U.S. are going up, there's going to be all this inflation. And first of all, there is no Japanese CPI data on this, I don't think this week, but there's a 75% correlation to U.S. CPI and Japan CPI. But think of the world, right? So everyone, or we can look at the data, right? And what do we see? Dis and deflation in Europe and Asia. And yet in America, right, we're going to have hyperinflation. Everyone goes, look at the money supply. Look at all these things. It's just going to go up, up, and up. It's going to be ridiculous. And yet people aren't thinking that we're in a global intertwined economy. You can't get massive inflation in one side of the globe and dis and deflation in the other. We're too interconnected. It doesn't work that way anymore. Now, there was a time that could happen. It's not going to happen this way now. There's just no way the U.S. is going to see massive amounts of inflation while the rest of the world is mired in dis and deflation. Just isn't going to happen. So keep that in mind. So if I'm ever wrong, you can send me a message about this video. Okay. But think about it. How is it even possible when you have globally connected supply chains that in Germany you could have more deflation at 0.3% and somehow that's going to translate into inflation in the U.S.? Let's get into some more data here. I want to look at the German ZEW current conditions. And this is is it economic sentiment, the one I want to look at maybe? And, it's pretty optimistic. You look at this chart And then you say, wow, they're really optimistic over there in Germany, and yet current conditions are really bad. And you can see here that they're in definitely recessionary territory. So even though current conditions are horrible, the optimism in Germany is off the charts. So that's very interesting to me. Something I'll probably mull over a little bit more in the future. How about the tick data? I didn't have this pulled up, but China bought $8 billion. There was a net purchase of U.S. Treasuries by foreign institutions in November, despite everyone saying that nobody wants Treasuries. Foreign buyers actually increased their overall holdings slightly. Moving into Wednesday, we've got Great Britain CPI up in December from 0.3 to 0.6, so a little bit of inflation going on in Great Britain. Producer prices on the input side are going up. So you're seeing some of the inflation coming into the factories from minus 0.3 deflation to 0.2 inflation, and coming out of the factories, well, slightly less deflation. So minus 0.6 to minus 0.4. So it's interesting that, the factories are pulling in inflation and exporting deflation. What does that tell you? Is the factories are not able to pass the prices on. They're a little bit, but not a whole lot. How about in Germany? PPI went from deflation minus 0.5 to a little bit of inflation at 0.2. Overall Eurozone and CPI is flat, deflationary minus 0.3%. Moving into today's data, mortgage applications down slightly. There was a flood of them. Remember, people were afraid of higher interest rates, so they were locking in those rates. This should, over the weeks or so that follows, however long the mortgage application process takes, would likely see that number come down. How about my friends up north in Canada? We've got a little bit of disinflation from 1% on the CPI down to 0.7. So it looks like Canada, in terms of inflationary pressures, is amongst one of the hottest zones out of Asia, Europe, and North America. So 0.7%, of course, behind the U.S., which has the highest number of all of them, but one of the hottest there. So looking at U.S. retail sales. Now we talk about, people having pent up demand, and people are focused on inflation. I don't really think people understand that if there was really inflation coming, which means prices are going to go up next week, next month, the month after, next year, there's going to be this constant fear of higher prices. So what would you do if you needed something? Say you needed a new toaster, you're going to go down and buy it. But what if your toaster is okay, but maybe could be going bad in the next year or so? You're going to buy one now because the price is going to go higher. And so you want to look at retail sales with that mind that if there was a lot of demand or fear of inflation, then the store shelves should be getting constantly wiped out over and over, just like we saw during the grocery stores during the pandemic, as people look to buy today out of fear of rising prices tomorrow. You could even look at it from gas prices. If people were really afraid of higher prices this week to next week and the week after, they wouldn't wait till their gas tank's on empty. They would wait, it's halfway full, but prices are going to go up some more. I better go fill up. That's how you should view inflation from a consumer perspective. So when we see this Red Book data, month over month, minus 2.5%, second month or week in a row, we've seen that decline. Year over year went from a whopping 2.1, remember these are not inflation adjusted numbers, to 2.2. So you're seeing 2.2% year over year growth in retail sales, which if we look at the graph of this, is slowing down. And that would not be consistent with people that are afraid of inflation. It would be consistent with the fact that there isn't all this pent-up demand anymore, or maybe it's exhausted, and there isn't inflationary fears among consumers. Today's 20-year bond auction, we're not going to go in details on it. It was an average auction. The 20-year's never been popular, so ever since it was reintroduced, it's just kind of been mediocre. So I don't put much stake on it, even though the markets did. Producer prices just came out of South Korea, slightly inflationary from deflation at minus 0.5% to slightly inflationary at 0.1% coming out of there. And then the API weekly crude stock, while we're on a roll here with data coming out, this is going to shock the market at plus 2.562 million barrels. Remember the API is voluntary, so don't put much stake in it. Look at the EIA tomorrow as we'll go over that. Okay, into the money supply. So remember I commented the money supply has been stagnating, right? And if we look at the graph of the M2 and we zoom in, we can see that it's not really growing much anymore, despite the fact the stimulus checks are going out. And as my buddy Johnny Bravo said, he says, hey, what's the deal? Why are people taking money out of their savings and putting it into checking? And then I realized when I paid my estimated taxes, as many self-employed and business owners do every quarter, and when our estimated taxes due, some people go, oh, the January 15th. And so what we're seeing ahead of time is money being moved out of savings into checking. It could be wrong to pay estimated taxes of what I think is actually going on there. And so that wouldn't make sense. What doesn't make sense is why the money supply is indeed flat. Now I want to look at, I'm going to pull this up, the money multiplier, because we just got this data and I forgot to have it ready for you. And what we see without any surprise is the money multiplier turned down. Now remember, if you're new to this show and you're like, what's the money multiplier? It is one of the best predictors of future inflation, disinflation, or outright deflation when the thing crashes. So when it's rising, it's suggesting there's going to be inflation because it means the M2 is rising faster than the monetary base. And we know the Fed can raise and lower the monetary base via QE, and the M2 is not directly affected by actions of the Fed. And so what we saw, and whoops, we need to go out a little bit, is the CPI go up a little bit to 1.3%. Still nowhere near what everyone thinks this thing should be, and the money multiplier went down. And so what it is suggesting, because you'll notice these two are fairly reasonably linked together, that this upward pressure on the CPI is going to turn lower because the monetary base is going to continue growing faster than the M2, as long as especially if the M2 stays flat. Now I want to talk about, I remember I mentioned gold mining stocks, so we have to get into that. So I've been waiting patiently, like, when are we going to talk about gold mining stocks? Well, we are now, because I pulled up this chart of 10-year Treasury yields versus 10-year Treasury inflation index yields. So we have yields versus yields, and you can see people buying tips are effectively buying a negative yield. Now, this is very interesting to me. When people say, well, I'm really worried about inflation, they're so worried about it, they're paying a negative yield on an inflation-adjusted security. So they're losing money off the yield to do that. But look at the relationship here. In red, you have 10-year Treasury yields, and normally they're fairly similarly related, which tells us one of two things so far. Either 10-year Treasury yields are way too high, potentially need to go negative or back to zero, or near zero, or everybody that's bulled up about inflation is massively wrong, and tips yields are going to go up and tips bond prices are going to go down. Now, what's interesting, if you look at 2008, and this is part of my there's deflationary shock or insolvency event thesis, is we will see 10-year Treasury yields in red collapse as we will see tips yields rise. And so it's kind of interesting. I've never looked at this chart before, but you kind of can suggest that the tips might lead it. Now, what does this have to do with gold mining stocks? I know you've been dying to know the answer, so I do want to show that to you. So let's go over here, and we'll say here are, GDX. Now, I do want to point out GDX is still telling us there is problems here because everybody thinks this thing is going to go up. But notably, when you see a trend change, it's going to cross the 50-day moving average and then run into resistance. Now, it got over it here, came back down, ran into resistance, crossed it, gapped up, pretty much almost back down below it. And today, tagged as 50-day moving average and was rejected. This is a bearish trend. Now, there are cases where it can be underneath the 50-day and cross over and rise, but just keep in mind, this is overall a bearish trend until it breaks down and ends. Now, let's overlay Treasury inflation protected securities, because one of these two securities is wrong. And so here's tips. Now you say, well, I don't really see the relationship. Well, it's pretty strong. There's a huge relationship between these two things. And you can see even over a 2-year period, very strong relationship between these. So when you see these jaws, these gaps between the price of one and the price of the other, it tells you one of them is wrong. So either tips are right and gold miners are a buy because they're going up, or gold miners are saying, no, things are going lower and tips are way overvalued, which means inflation expectations are wrong And the market is wrongly positioned against those. And that means broad equity prices are also coming down if we see gold mining stocks come down. So this is a proxy of liquidity. It's something that I look at, and hopefully maybe something that you'll start to look at too. Let's get into the commitment of traders. So from our friend Brent Johnson of Santiago Capital, it looks like the net position of speculators was increased. They went to a now 196,000 net short positions. Here's the infamous chart that we all like to look at going back, and you can see they're still deeply short. No, they're not as short as they've always been, but they are deeply short. Now let's take a look at our chart from Stefan, who overlays TLT on the top, and the same chart from Brent on the bottom here. And we can see that TLT has been heavily sold, not only due to quants, which we'll get to in a minute, or CTAs, but due to speculative selling on the futures market. So you have two very large sellers of Treasury securities here betting on inflation. And when you see these big moves down here, they're ripe for reversal. So let's look at how the CTAs position, because we've talked about this in the past, how the CTAs have been massive sellers. They said, look, when they finally stop selling, then we're likely to start seeing a reversal because of what happened. Now, if you remember what happened back in August of 19 to January 2020 versus now, you see the same 6-month selling spree that ended. And then within like a week or two later, the CTA started buying back in, and that you're going to see that is pretty much about to happen again. So this is an old chart that I got off of Zero Hedge. Some of you read that, and it shows a net positioning. So it says now, this is not where they're at now. They're pretty much right over here, and I'll show you on the one I got today what's going on. So what you're seeing here is the CTA net positioning on the Treasury futures versus yield. And as yield goes back down, what will happen is the CTA positioning will go back long. Now, if we can only imagine with the Fed buying, what they will do if they go back long, how much lower yields will go. That means they'll probably go below 0.5 and have every chance of pulling a very overly bullish market down as yields on the 10-year go to zero or possibly negative, just due to the massive buying power. So where are they today? Well, this is a chart from Nomura today. And if we look at 10-year treasuries, based on the article, it said they're about minus 1% short. So they're negligibly short. But if you look at the level to sell, so the current levels, every day these things rerun their formulas. It says current level is at 137. Level to sell is at 128.6. So if I'm looking at this and I'm worried about more downside move from the CTAs, they're not likely sellers unless prices go down and interest rates go up quite a bit more. Level to buy is at 137.8. So 137.8. So it won't take a whole lot for that minus 1% short to go back to neutral. And then who knows, how quickly from there it will start going back long. Now, if you're looking for S&P 500 positioning, what's going on with that? Well, current level obviously is where the market's out today. Level to sell is 30.32. Level to buy, it says NAN. That means they're already in at max positions. These things are already all in. And so there's a long way off before they even, are concerned about selling. But what I find most interesting is this 10-year treasury. If you look at it from a chart perspective, now let's go look at TLT. We're starting to see early signs of the bottom. And, on the Sunday chart show, for those of you who don't watch it, we do look at momentum. We don't have a signal, not even the first signal yet, but we're starting to get a little bit of a taste that this could be a bottom. And that tells me that we'll probably get confirmation of the bottom should prices get back up here. And somewhere up in here is where we'd likely see those CTAs come back in. So if I'm looking at what's going on in price action, what I'm happy to see is there isn't likely more selling pressure. Now, the same event happened, as I mentioned, back down in here where the CTAs finally finished selling. And this was back in late December, early January of 2020, January 2020. And then bond prices went back up. Now, Fed was doing QE, but only on T-bills. Now they're doing it the long of the curve. And there was disinflationary pressures. We see that with the money multiplier. And then what happened, the CTAs went from a 6-month selling spree to a 3-month buying spree. So I'm very interested in seeing them come back in here. Well, maybe over the next week or two, it'll be very interesting to see how that goes. because the market's not expecting that. How about the dollar? See, the dollar is another big key in the deflation thesis here, because this is taking in all views of the dollar, the euro, Japan, pound, Swiss, I forget what it's called. I know you'll remind me. I'm not worried about that. But what you see here is everybody on top, right, is betting on everything but the dollar. There's a little bit in the emerging markets, but all the speculators are long every other currency except the dollar. So keep that in mind. Now, the last time they were mostly long everything but the dollar, it all finally reversed. So when you have everybody on one side of the fence, eventually the market shifts to extract as much pain from those people as possible, and the dollar started to rally. Now let's look at this similar chart from macro charts, and this is fantastic because they're showing the total US dollar positioning and key support. So the dollar's back at a level that it's seen in 2018. We've talked about that. And it's in the bottom 1.5% of all-time total US dollar short positioning. So if we come back here, it's telling us that there's so many people betting against the dollar, it's historically an anomaly. Now down here they note, and I almost missed this earlier, in September 2020, the dollar bounced 3% from less extreme positioning. So he's asterisk right here. So it bounced from this position up to here, and stock indices fell 10 to 15%. Now, one thing to understand is people are like, how can you be so bearish on the U.S. equity market when stocks are massively overvalued, maybe more so than ever in history? It's because when you start to understand that when these quants, CTAs, start to come back into the bond market, which they will, it's going to put massive deflationary pressures and drive interest rates down. Now, what does that mean from a market positioning? From macro positioning, means financial conditions are tightening. Now, they're already tight, but the market is making it look like they're not. Then you look at the dollar. What is the dollar? It's an overnight duration bond, right? Is this all it is? Effectively a zero duration treasury bond or overnight security. So when bond prices rise, that's why you typically see the dollar. Well, guess what? Everyone's short, as I just showed you, in terms of the futures market. They're very short the bond market. The CDAs are all out. We're slightly negatively. The dollar is heavily bet against, right? And so what do you have that comes next? You also have call options from small traders, all-time high. This is not normally how bull markets begin. So you have massive amounts of speculation in the equity market, and you have some positioning that could completely unwind all of this, and none of these people are hedged against any downside risk. And you even see from an insider perspective, this is a great chart that was floating around Twitter today, inside selling. It means that corporate insiders are selling at the highest rate ever. So while retail is buying call options, YOLO, from my dad and my wife, that means you only live once. While you're buying YOLO call options on inflation and markets going up, the big players on the inside are unloading. Last chart I want to look at is this net interest margin. This came from Stefan. Some people ask, why are banks doing QE? Why don't they want to lend money? Well, because this is what banks make on loans. They make what's called the net interest margin. So going back to 2000s, they were making 3.8 to 4% on a loan. Today they're making 2.68. Why don't they want a loan? There isn't a lot of margin for loss. I mean, and this is a great chart that illustrates that, because if your spread is 2.68% and you have too many defaults, you lose money. Why don't banks want to lend? They don't need to. They're making money on QE and stock trading and other things like that. All right, well, I think that is way too long for the show. Hope it was worth the Monday wait. But anyways, thanks for being fans. You know the drill. Like, subscribe. I can't use stick figures. Saved my life. And with that, I will see you on Friday, where we'll expect to see what? Yeah, that's right, more contracting credit data. I'm Steve Van Meter. Bye now. The content of this video is provides educational information and is not intended to provide investment or other advice. Material is not to be construed as a recommendation or solicitation to buy or sell any security, financial instrument, or participate in any particular trading strategy. So it was paired by Steve Van Meter. Personal capacity opinions expressed as fair of that of my own and do not reflect the view of Atlas Financial Advising or Steve Van Meter Financial.